evening, everyone. Thank you for joining our CIO series exclusive seminar in partnership with Nasdaq. Today, we have over 200 registrants online and around 40 guests in person with us. We are also honored to have 3 industry experts with us today. But first, let me introduce Wang, our Chief Investment Officer, as our host today. Qi has 28 years of research and investment experience in the US, China, and global markets. His expertise lies on studying disruptive changes such as tech innovation and the investment implications. So without further ado, please welcome Wang Qi to the stage. Qi, please.
Okay. On behalf of both UOB Kay Hian and Nasdaq, I would like to extend a warm welcome to all of you in this room here and those online. We have a distinguished lineup of speakers today. Phil Mackintosh is the Chief Economist and Senior Vice President of Nasdaq, will be our keynote speaker. Phil brings over 30 years of experience in investment finance and now leads microeconomic research at Nasdaq. And later on the panel, we will also feature my colleague Wendy Chen, our Chief U.S. Strategist online, who also brings to us extensive experience in U.S. and global markets. And for my opening, I actually prepared a 2-hour speech, followed by a mandatory exam all of you have to take, including those online. You cannot leave this room until you complete the test. Okay, anyone took it seriously? I'm being very serious, okay? But you know, that's definitely not my style. Plus now we have a star of today who's Phil, will share his insights on the US market. So we'll leave most of the time to him, but I do want to use a couple of slides if you don't mind. My slides are always very fun, so hopefully it's not too much painful to go through to set some context. And the theme today is about AI tailwinds versus macro shocks. It sounds really academic, and I struggled how I can visualize this for you, how I can use some personalities to express what I mean. And the 2 best person came up to my mind was Donald Trump and Jensen Huang. Right? I keep thinking it's a Chinese name. So that's very stereotypical today. You have a crazy president that starts wars, cause market volatility, cause all kind of risks on the top-down side, and then you have an AI visionary who is driving, almost single-handedly driving the whole industry, right? And I heard this saying online recently, I think it makes a lot of sense. They said, for any short-term trading, you got to follow Donald Trump. For any long-term positioning, you have to listen to Jensen Huang, because everything he said almost is coming true, right? Remember that? 2 years ago, he talked about memory happened. Talk about models happened. Talk about networking optics happened. Okay, so no doubt that these are the 2 most important people that we should track, and not surprisingly, we are helping you to track this in our US bi-weekly outlook. Another reason to follow and read our research. And if you don't read English, no excuse. We have a Chinese version for that too. Okay, so talk to your representative, get access, sign up, and we will help you track what Donald Trump is trading and also what Jensen Huang is saying. For time's sake, I'm not going to go through all of it, but let me just highlight one more point before I hand it over to Phil. If Donald Trump is not becoming the greatest trader in the world, what are these M7 companies, big tech companies becoming? It turned out that M7 is becoming G7. Anyone watching the May G7 meeting? Who is sitting at the table with the prime ministers, the presidents, and the head of states at the G7 in France? Certainly not me, but it was OpenAI, Anthropic, Meta, Google, Amazon, you name it. All the stocks you trade every day, okay? So what I try to say is that maybe these companies are more like countries now. Certainly in terms of market cap. Come on, $1 trillion market cap. How many countries have $1 trillion GDPs, right? Hundreds of billions of revenue and profits. So financial power, these companies are like country. Politically, they're sitting at the table with the world leaders. And let me just take another angle at this. What are these companies doing? They're investing in data center. What is a data center? Data center is land, is building, is water, is electricity, is chips. What are these? Uranium, copper are used in electricity. So they're investing all these hard assets. Really, we see these gigantic corporations investing hard assets in that big scale as much as like a country. That's countries thinking, okay? That's Singapore government thinking. We want to invest in the hard asset, we want to invest in the infrastructure, we want to invest in land, water, blah, 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 right? So do you agree that they're almost like a country? So maybe I'll ask Phil that question later, maybe we need to approach them with a slightly different framework. You know, if there's no longer just a typical business company. And lastly, let me just throw out there AI tokens. The word token itself already suggests it's kind of like a currency. Why it could become a currency is because it's commonly accepted, it's a unit of account, and it's becoming very popular. And maybe in the future, it will be becoming indispensable, whether you're a consumer or enterprise. Okay, I promised to be short, so I already overextended myself. And before I turn over to Phil, I just want to leave you with our top 5 predictions for 2026. No time to go through it all. I just want to say that we were wrong in one of the 5, which is the great AI slowdown. AI did not slow. In fact, AI accelerated. And then with the very complicated macro picture, I think there's a lot more we can discuss on what the future holds from here. With that, let me turn to our main speaker for today, Phil Mackintosh, Senior Vice President of Nasdaq, to give us an overview of the U.S. market. Thank you.
All right, thanks very much, Chi. So yeah, I'm going to talk about a movie, right? Has anyone seen this movie? One Battle After Another? I'm joking. We're going to talk about a few different things that are affecting the economy. COVID is still, I think, in people's memories. The fact that they were late, like the Fed was late to increase rates when energy prices spiked with the Ukraine war and we had inflation that got a bit out of control, I think is why Warsh, who was put into the Fed as a rate cutter, is now talking about rate hikes, which is important for companies and interest expense and maybe important for the long end of the US curve. So I think COVID's still kind of hanging around. Tariffs, I know, is last year's story, and it turned out to be nowhere near as bad an economic impact as we thought it would. But this year's story is all about the war and the oil price and potential shortages. And despite all those negatives, we still have stock markets pretty close to all-time highs. So we're going to talk about why. But let's quickly just talk about some of the data on tariffs. And I wish I had this chart last year. What it shows is, because last year a lot of Asian countries thought that with the tariffs, their exports to America would stop. The companies that were selling to America would have no sales, and they would have to let people go and retrench people, and we may have a recession because of all the unemployment. What this chart shows in black is the cost of labor in a lot of different countries compared to the cost of labor in America, and then the red is the tariffs on top. And what you see is even with the tariffs at the levels that they were levied, really a lot of countries are still pretty competitive and cost advantaged to the US. So what we've seen is actually very little impact from the tariffs because most countries are still ahead of America in terms of cost benefit. In terms of who's paying for the tariffs, I think the expectation was that American consumers are such an important customer that exporters would discount their exports so that when the US customer saw the prices, it was basically unaffected. What's actually happened, if you look at the data, is most exporters have sold their exports to America, and the importers have added the price on to the tariffs, and then they've sold it to the customer. So a lot of the inflation has actually hit the American economy, and American consumers are basically wearing a lot of the tariffs. So let's talk about the war and oil, because that's a much more timely topic. And it's kind of interesting, if you look at the data, the impact on the supply chain from the conflict this time is bigger than all of the other war and conflict that we've had in the Middle East. All right, so with a supply shock, you would expect the bigger the supply shock, the more price has to go up to account for it. The reason that the supply shock is so big is because of the geography of this region. So, in the past we've had Iraq and Iran at war. That's just two countries. Or we've had Kuwait and Iraq at war, and that's just two countries. But because Iran has shut down the Strait of Hormuz, you've basically got Saudi, Qatar, and the Emirates also, with their oil and gas production, unable to get the commodity out through the Strait of Hormuz. So this war affects the whole region's exports. And when you look at that orange arrow, most of the exports went to this region, to Asia. Right? So this region has a lot of more dependence on this conflict than America, even though America started the conflict. If you look at the stats, 20 million barrels a day in that top right-hand corner, missing from the global output and exports. That's 30% of global trade on the sea and 20% of LNG trade, right? So massive percentages of energy that used to be in the system. What's interesting, given that, is the oil markets and even the stock markets have not really been that affected. So this chart here looks at the price of oil adjusted for inflation. And you can see, like, we went up to about $100 and then we faded back down and we're still below $100 now. That's lower than where we hit when Ukraine was invaded. It's a lot lower than what happened when we thought we'd hit peak oil in the 2000s and we were going to start running out of oil. It's even lower than in the 70s when we had oil embargoes and the second shock from the Middle East conflict. So why is the oil market, like, kind of so nonchalant about what's going on when it's such a big shock to supply? And the reason is a few different factors are helping to offset what's going on. One of the biggest offsets is this chart. It shows that the global economy now is much less dependent on oil. A lot of companies make things, especially service companies, that don't really need oil. A lot of electricity around the world is actually being produced with alternatives now. So you look at Europe, a lot of the countries in Europe have about 30-40% of their electricity coming from alternatives, from wind and from solar. So the oil itself, and coal as well, is becoming much less important to the economy and to keeping the economies around the world going. The other thing that was announced a while ago is that countries with strategic petroleum reserves, so savings of oil, were going to start releasing some of their savings. And so what you can see in this chart, all the little red arrows, you can see boats that are coming back from Asia, empty, going all the way to Texas to get some of the US oil out of their petroleum reserve and then take it back to Asia. So we've seen the petroleum reserve in the US go from about 450 million barrels down to closer to 300. So there's been a fair amount of supply hitting the market from the US petroleum reserve as well. And despite that, we really haven't seen an uptick in what's going on in the Strait. So we may have had ceasefires, we may have had deals. There was obviously kind of an uptick in ships getting through for a little while, but the more recent data is more like the data in the middle here. Even though we've got a ceasefire, even though we haven't seen missile strikes for a while, we obviously still have the economic effects on the supply chain of oil coming through the system. So the big question, I think, is, could this cause a recession? Right? And the logic of that is actually oil, it makes inflation higher. We can see that in the inflation data at the moment. But also the tariffs made the inflation higher. And because of that, interest rates have gone from maybe being cut to being hiked. And a lot of economists think it's not necessarily the oil and the oil shortages that will cause a recession, it's the interest rate hikes that will cause companies to have more interest expense and need to cut costs, let people go, and that will cause a recession. So unfortunately, you've got sort of three different levels of almost man-made inflation at the moment. And so the AI build-out, which I'll talk about in a minute, is just part of what's happening to the inflation story. People are suddenly talking about interest rates going up because of all of these things contributing to inflation. And you can kind of see that in this chart here. Before the Iran war, everyone in America, like we'd left rates artificially high because we thought that the tariffs would cause inflation. Turns out they really didn't. But we thought we would see 3 more cuts throughout this year. As soon as the war happened, everyone pivoted from thinking there would be no chance of hikes to no chance really of cuts. All right, so the whole market is looking very closely at the oil inflation that's coming through the system, and that's why I say COVID, I think, is kind of forcing people to think that the Fed will really quickly act to tamp down the oil inflation. That's not good for companies, right? Because companies have interest expense. If interest rates go up, they have more expense. If interest rates go down, they have more profit. And so we had started to see a recovery of companies' profits. This is going to make it harder for companies to make profits. So given all that negative information, why is the stock market at all-time highs? It's a lot about AI. And AI is actually boosting the economy as well. So I want to start with this chart. That's obviously a map of America. It makes sense to start with a map of America because if you look at compute, it's about 75% in America. If you look at AI models, a lot of the models are American. So in terms of building AI, it's a very American-centric thing at the moment. The green dots in this chart are all the data centers in America now. The yellow dots are all the data centers being built or being planned. All right? And just to put it in perspective, this one in the middle here with the blue circle is the Meta data center in Louisiana. It's that big. All right, so for anyone that's been to New York, this is the island of Manhattan. You've basically got Central Park in the top half covered, and Central Park has a 10-kilometer running track in it. It's not a small park. Then Times Square is kind of underneath here a bit. Madison Square Garden's underneath the bottom bit. It's 100 blocks long by about 5 avenues wide. Like, it's massive. And the point of this is when you start looking at the performance of the chip stocks and all of the other stocks that are affected by the building of these data centers, you realize like how many little tiny chips it's going to take to fill racks of servers, head height, and go all the way up to the end of this data center. Right? That's why you start to think the scale of the demand that these are going to create for the complex, the ecosystem of AI, is really quite massive. And so what's happening in the economy, if I was talking to you 2 years ago, I would have said the US economy is doing really well because of the US consumer. Right? The US consumer had saved a bunch of money during COVID. They had seen their wages increase faster than inflation, and they were spending it. And so that was the only thing really driving the US economy. We weren't seeing any capex. We weren't seeing much investment. That's all changed. Now the consumer is weakening, but as it's happened, the AI complex is starting to spend capex. We are seeing massive investments in the economy. It's actually affecting jobs, plumbing jobs, electricians' jobs, and demand for things like roofs and walls. In countries like Australia, in countries like Taiwan, there's also the start of a build-out, right? So AI is going to create some tailwinds in this region as well, on the construction side, more on the demand for chip side as well. So this is something that's going to affect the world as everybody builds data centers for their own regions. So let's talk about stocks, and I want to start with something kind of elementary. The blue line in this chart is stock prices. Right, we go all the way back to 1940, so about 80 years worth of data. The green line is the earnings for those stocks. And if there's nothing else that you take away from this chart, it's that stock prices go up because companies earn more money. Right? And where we are right now, the green line is in line with the blue line. So basically, the market hasn't kind of got ahead of itself, people would say. The market's going up because earnings are going up. And actually, the Mag 7 stocks, their earnings are going up faster than their prices, so their PE multiples have been coming down this year. And if you think about it, I don't know how much you guys look at price earnings multiples, they're kind of stable typically, and when they get high, it's a sign that a company is relatively expensive, and when they get low, it's a sign that it's cheap. Guess what this chart shows? Prices and earnings are meant to go in step. That's why the ratio is constant. If we look around the world, though, it's kind of a good story, right? We talked about how interest rates have been coming down. We talked about how inflation's come down. Because of that, companies in all sorts of segments of the economy are starting to make more profits. So this chart here, the inside bar is last year's profits. The outside bar is this year's profits. And you can see it doesn't matter whether you look at Europe, US small cap stocks, Asia, or even emerging markets. We've had back-to-back years of profits growing, which is good for stocks, good for stock prices. Okay, it's not just the Nasdaq 100 that's had really good earnings growth. The Nasdaq 100's had it for a bit longer. That's the main difference. When we do look at across the spectrum, so this is for America, small cap, mid cap, S&P 500 is large cap, Nasdaq 100 is the top 100 stock listed on Nasdaq. When you look inside what's driving the earnings growth of the larger cap space in the US, it's a lot of the hyperscaler profits. Right, so 76% earnings growth explains a lot of stock price performance. Half is coming from, or more than half is coming from hyperscaler profit growth alone. Okay, so the AI complex is really driving a lot of the earnings growth in the large cap space in America. And the reason is just how much money companies are spending on the capex to build the data centers and to build the AI models that we're all meant to be using 3 years from now. What's interesting is last year they spent about $500 billion building that out, and next year they're meant to spend about $1 trillion. Right? The US economy is $30 trillion, so that's 3% of GDP right there. That's a lot of capex. What's interesting is these companies, at least the four on the left, already have really good businesses. Most of you probably use Microsoft software, and Facebook or Meta, or one of their products for social, and Amazon for products. They make so much profit. The black line here is the percentage of cash flow they've been reinvesting up until now. And the right-hand axis, you can see it's been about 40 or 50%. So they've been reinvesting just a portion of their profit. But because we're at the point with AI build-outs that everybody needs to have the best models so they can be the successful AI provider to all of us 3 years from now, they're all starting to step up their spending. And the expectation is it'll go over 100%. Right? So they're not actually going to have enough cash to put into their data centers for maybe 2 years in a row. And that's why a lot of these companies have been borrowing money this year, right? Before it's too late, before it looks like they're running out of cash and need to borrow desperately, they've been pre-financing because they know they've got 2 years of spending to build massive data centers. We can see that the trade is sort of starting to evolve. I think investors are starting to think differently about who's going to win from AI and trying to work out who's going to win from AI. And it's kind of a complicated set of maths, and a lot of things have to be forecast very accurately. I mean, the point of this chart is to show as new models come out, the models tend to earn pretty decent revenues for the queries that we throw at them. So this is, on the left-hand axis, dollars per million that you can sell the queries that AI answers. But if you're not on the cutting edge, the depreciation or the devaluation of those models goes down pretty quick, right? You can go from getting $10 to 10 cents pretty quickly. So you need to get the next best model and the next best model so that you can keep earning premium rates. You also want market share, right? You don't want to have the model that no one likes the answers of. You want the better model with the better answers. And so keeping market share involves staying at the front end of this curve. What this chart here sort of shows is a combination of the things that we've been talking about, right? So the free cash flow and the profitability of the companies up until now has been really good. They're expected to have a lull in cash flow, not profit, but cash flow in this period here. And then they're expected to have AI earnings on top of all their current businesses. And the analysts on the street think that it's going to add up to even more than the earnings they had before. Okay, so that's important. What's interesting is looking at what the market's been doing. All right, so we talked a lot about Mag 7. Chi talked about Mag 7. Mag 7 in this chart is the blue lines. It's kind of gone sideways this year. What's happened is people are thinking, there's a bigger ecosystem out there than just those 7 companies. And in America, we don't really have any power stations getting built, so a lot of the data centers are going to be off-grid. They're going to need to build their own power generation. And so you can see companies here that were in nuclear, gas turbines, solar, anything that can be put into a campus with a data center is catching a bid, and it's up significantly. Some of the tail off here is actually because some states in America decided they don't want data centers. All right, so maybe you won't be selling as much energy production because those states won't allow it. But then we've had this other rally in the orange colors, which if you look at the tickers, is a lot of the chip production stocks. And we saw how big that data center is. You can visualize the demand for chips. If there's a lot of demand, prices go up. If the prices go up, margins go up, profits go up. So should company stock prices. Arguably, the sort of rally that we saw and the retracement here, it got a bit ahead of itself. So the earnings growth is more like where we got down to with the retracement. strong earnings growth, but not the peak earnings growth. And the expectation is the next couple of years they will keep earning with earnings growth. The question is whether where we got to at the peak was a little ahead of where the market's going to get to. Okay, so if you guys are thinking, I want to buy the AI trade, I want to buy this ecosystem, what we're thinking about, there is a lot of big hardware companies in the world. Some of them are in Asia. So you've got Taiwan Semi, you've got Samsung and SK Hynix, you've got some Japanese companies here too. You've got ASML, which is really important to the silicon side of making chips. That's in the Netherlands. But all of the companies at the top in blue are American. And I think it's cool because a lot of them are Nasdaq listed, right? And because they're Nasdaq listed, they're in the Nasdaq 100, which we just heard about. So Nasdaq 100 also has ASML, and SK Hynix just did an ADR offering, so it possibly will be in the Nasdaq 100 soon as well. So a lot of the exposure that you'd want is pretty simple to buy in the Nasdaq 100. But this is it's a lot of companies in the ecosystem, but there are a lot of American companies. And so what we're seeing in America is a lot of Asian investors want to buy American stocks, but you guys want to do it when you're awake, which is when I'm asleep. All right? And the market is different when I'm asleep. When we look at the data, this is Ingrid Werner's an academic in America. She got the data for who trades in the American overnight. It's a lot of Korea, but it's also a lot of other Asian investors, right? Not many Americans stay up overnight, but Asians want to trade in the Asian day. And what does Asia trade in the Asian day? It turns out we have about 10,000 stocks in America. The top 15 names make up more than half of the value traded. So it's pretty concentrated. But what it's concentrated in, if you look at the blue box at the top, is a lot of these names that are in the AI complex, right? It changes over time too, but very much AI trade stocks. If you guys want to get exposure to the AI trade, you've almost got to trade these American stocks. If you look at the ETFs that get bought, sort of a similar story, right? You've got the Nasdaq 100 and you've got the triple levered Nasdaq 100. You've also got semiconductor ETFs, which we heard about a few minutes ago. And even the S&P 500, a lot of the S&P 500 is those large cap growth US companies. So you can kind of see investors trading AI stocks, trading American stocks in your daytime, my nighttime. The problem with trading in my nighttime is we shut the computers down, basically, in America. So during the day, there is a concept of a best bid and offer. We have 17 different exchanges, and there's a computer that listens to all of them and works out which exchange has the best buyer and which exchange has the best sell price. And so the trading cost, or crossing that spread cost that's the cheapest, is the difference between the bid and the offer. We also have rules that require brokers to trade no worse than that price. And we have things like 605 is just it's basic an accounting report that gets done every month that quantifies how many bad fills clients have been given. And so you can see that rule is very closely applied. We have things like limit up, limit down. So just in case someone has a massive order and they don't realize the stock is pretty illiquid, we don't want the stock to go up 40, 50% if it hasn't had any news or any good profits. And so we have limit up, limit down to sort of stop a stock from trading and give the market time to come and adjust. After 4 p.m., we still have the bid and the offer quotes, but we also have earnings news for a lot of stocks. So we take away some of those buffer zones and protections just so stocks can move a lot. And we see the same thing in the morning. You get economic news in the morning. You get some stocks doing earnings in the morning. We had the news from Moderna a week ago where it sort of has cured skin cancer, and so its price doubled overnight. And that's what it should do, right? It shouldn't be stopped just because it's going up on a news item. So we kind of take away some of the buffers, but in the nighttime, which is your daytime, there's no prices, there's no trade prices, there's no bids and offers that you can really see, okay? So it's harder for you guys to trade, to see what's trading, to see what's the right price to trade. Come December 6, pretty soon, really, it's going to look like this. So you're going to have a bid and an offer that runs almost all day. You're also going to have price limit buffers to stop prices from going too far during the night, especially if there's no news. That'll protect investors a little bit. And this is going to happen from 9 p.m. all the way through. So that's 9 a.m. your time. So it's going to look a lot more like the way US day looks. Okay, so I have one final thought, and it's actually I'm going to take you back in time to the tech bubble. right? So the tech bubble had a lot of similarities to what we're seeing now. It's a very technological trade. There was a lot of stocks that had pretty high price earnings multiples, had a lot of rally. We know what happened with the tech bubble. It burst. But what's interesting is what happened to the stocks that we love nowadays, which are all worth multiples on the right-hand side of when they started, okay? If you look at Amazon, which is the orange color here, it was your classic .com stock, right? It was a bookstore with a .com address, and in reality, we couldn't buy enough books online to justify what we'd put into building the website. And so it fell 90%, effectively from $1 to 10 cents. Obviously not that price, but since then it's rallied, right? And what it's rallied on is the fact that its engineers realized the computers they'd built for shopping for books weren't getting used overnight, and so they redesigned their computer systems so people could rent the compute. Became cloud compute, which we're all using now to factor AI models. It became Amazon Web Services, which is a lot of the revenue that Amazon makes, right? And now it's worth 63 times what it was at the start of this chart. You could look at AT&T, which is the gray color. I mean, AT&T built the internet, right? It had the copper wires that came into everyone's house. Then it laid the optic fiber that we watch cable TV and pipe our internet in. It had mobile towers put up, and then it went to 3G and 4G and 5G, right? It built the internet, and its stock price is down. All these other stock prices are up. But you look at when they IPO'd, the dots in the start of the chart, they all came after the internet. These are companies that are doing things that we love that you couldn't even think about before the internet was built. And I mean, think about Meta. Like, you can't do social media on your phone without the phone. So you need Apple and Samsung to build the actual phones. You need the internet to be available, and you need the mobile to be available, right? So these are building off the platform that was the internet. You think of Netflix, right? You can't stream a movie if there's no broadband. You look at Google. I mean, Google or Alphabet, you can't search the internet if there's no internet. The point really is the companies that we might want to really own that might become massive in 20 years from now might have products that we can't even think about right now. So it's an interesting trade to think about which companies to be invested in and how to diversify so you don't miss those opportunities that are going to be the success stories of the future. Okay, and I do a blog. If you want to sign up for it, you're welcome. Some of the charts that we've shown you tonight, you'll see it's a relatively short weekly blog. Little plug for me. Thanks.
Thank you, Phil, for the sharing. Now we would like to invite you and Chi to the stage for the discussion and Q&A. For our online participants, please submit your questions via the Q&A function. Guests with us in the room, please raise your hand if you would like to ask a question. Thank you.
Okay, so how much time we got? Yes, we have plenty of time for Q&A. In fact, Phil and I had this similar session in Hong Kong. It was a really good conversation. I do have lots of questions, but maybe we should open it to the floor first.
Did we not scrub out the hard questions from Hong Kong?
Yeah, well, there will be hard questions. Don't worry, okay? I'll prepare that for you. Okay, so any questions, first of all, from anyone from this room? Okay, please use the microphone.
I have a question regarding oil price. Suppose the Hormuz Strait is choked permanently. Okay, so it cut off 20% of the world oil supply. Are the rest of the world able to increase the amount of supply such to make up the shortfall, which means that oil price will go back to the more normal price level? Yeah, what do you think? Is there anybody who did a research on this? Are the rest of the world able to supply sufficient oil, assuming that the oil just cannot get out of the Hormuz Strait?
Yeah, I mean, so I have more charts I don't show you guys because we have a shorter presentation, but there's already a bunch of pipes in the Middle East that didn't exist in the 70s. So Saudi is able to pump 5 million barrels a day across to the Red Sea and come out that way. And even if the Houthis close that off, they can go up through the Suez and there's another pipe. So that's a quarter of what we sort of mentally think is stuck coming out to the south. There's also a pipe in the Emirates with 1 million barrels a day of capacity. There's also a rumor that the boats inside have been turning off the transponder and getting out overnight. So there's I think less of a restriction to the supply than we think anyway, coming out of the Middle East. But I have heard, and I don't know if you've heard this, that if everything gets resolved, and we saw when the deal was struck, like we kind of got back to almost half normal levels pretty quickly, we could have a glut. Because to your point, Venezuela's doing more oil pumping now. Brazil's meeting up extra demand. Like there are countries that have started to lift production because of the conflict that are kind of meeting the demand now. So supply is caught up. If the supply comes back in this region, we could have a glut where there's more oil being shipped than there is maybe refineries to refine it and containers to put it into, and then the price might not just go back to the old normal, but even lower. So I don't know if any of you guys remember, but when COVID hit, and I'm not saying we're going to go to COVID levels, when COVID hit and obviously no one was going to be catching planes and no one was going to be driving to work for a while, oil went negative for one of the futures expiries because we literally didn't have enough place to store it, and it just keeps coming out of the ground. So it's not like a commodity that you can just turn on and off.
The cost of carry, yes. Let's not forget, my colleague Wendy is also on the line. Wendy, you have any insights to the earlier question on oil? Hello?
Hello, hi. Can you guys hear me?
Yeah. Will oil
Okay,
go
great.
back to the normal level if everything returns to pre-war supplies
Yes.
situation?
Right. I think on oil, as Phil already pointed out in the slide as well, there are some couple of things that's helping us go from this catastrophic level of when the war first break out, everything that is going above 120, probably heading all the way to 150. But after that, you see all the countries around the world start to release their strategic reserve. And historically, we see less and less concentration in the oil intensity of our economic, as well as, of course, other alternative. Let's not forget, OPEC is not the only country supplying oil in the world. So after we see this drop from Middle East, a quick take up from both US, Russia, and some of the non-OPEC countries that's actually filling this hole. I think, however, if this war, let's say, knock on wood, not, but it's going to last for long, then this whole Straits going to be blocked much longer than everybody expected. There could be some risk that all the strategic reserve going to have one day is going to be depleted, especially those in East Asia, such as Korea and Japan, and even China in a sense. So let's just say if this situation, we don't see any sort of improvement 1 year from now on, we're probably going to see some problem.
Yep. Got it. Any questions? Okay.
Hi, Phil. Thanks for presentation. My question is about interest rate. What do you think Fed will do this time? And despite all the earnings, you pointed out why the stock market is so high. Think with the interest rate, I think everything will crash.
So on the second part, I agree with you. I think if we get a hike,
Right.
especially a hike that really people don't expect,
Yes.
it will shock the market in a bad way. It will cause the cost of capital to go up. It will cause earnings to go down. So I think you're right. I think if we get hikes in interest rates, especially broadly around the world, it would be a bad thing. I think the reason for that will be oil going up, like
Yeah.
we just heard about. It's possible. I don't know if it's probable at this stage. But my thoughts on the oil price is realistically, inflation in the world was coming down. It was coming down slower than everybody thought it would because after the COVID inflation spike, everyone's wages took a while to catch up. And so we kind of had people still getting catch-up salary adjustments, which was factoring into a lot of the services costs in America and Europe, around the world. But it was coming down. And you saw the US consumer in my charts was softening. Like there is no reason for rates to go up but for oil prices right now. And so I think the more likely direction of travel is if oil, even if we don't get a glut, if we just see status quo for it right now, we're already seeing the inflation come back out of the market. If we can get 4 or 5 months out, I think the next direction is a cut. And I personally think because of the demographics around the world, so if you look at all of the different continents in the world, there's only one continent having enough babies to grow its population, and that's Africa. Right? So if you think about Japan in the 90s, its population started to shrink, its workforce started to shrink, and it was really hard for it to keep its GDP growing. Like, it needed productivity to grow faster than its population, its workforce was shrinking just to hold steady, right? So we need productivity enhancements around the world just to stop GDP from falling. And the economies are going to be slower if we're not having babies and not needing extra houses and not needing extra cars and not needing clothes for kids that are growing out of them. So the level of interest rate that we got used to in the 70s when that was what was happening is going to be different in the future, because I think global economies are going to run cooler because of demographics. So I think we should get used to rates being...
Despite the AI?
So the AI is the counter argument. If we had another economist sitting next to that would argue with the fact that the AI itself isn't, the chart I had where it's like a man-made bubble of inflation, and it's going to fade. People will say AI and also the politics at the moment with tariffs and nationalization and kind of becoming more protective internally is going to make trade less efficient and make things cost more. And so people ask, like, other people are saying we have a systemic increase in costs, which is going to last for decades. That's one reason why interest rates around the world are starting to go up at the long end. So I think the market is telling you you're right. I kind of feel like
of the yields, the treasury
yields are going up because everyone thinks we're going to have actual structural inflation in all sorts of countries because of trade being less efficient, because of AI being so expensive, it's going to push demand inflation. So that's your two schools of thought. Someone's going to be right, someone's going to be wrong, but I just think the demographics are a pretty big headwind to overcome.
Okay, thank you.
You're right.
Yeah. Wendy, do you want anything to add on the rates?
No, I think that's Phil covered it pretty clearly. I think probably one thing I would note that we are right now half a year into the Iran crisis, and the most bizarre part in my view is that we already see oil elevated for over half a year. However, in the US CPI inflation data, we don't really see any proliferation outside of the oil related category. So it's almost seems that this what Powell argued, that those kind of external shock is nothing to shift their long-term structural call for inflation. It's almost there because you see we don't really see that much proliferation outside oil. However, I do hold the view that over the absolute longer term, inflation is pretty structural because we are in the world of unfortunate deglobalization. So all the historical way of using East Asia, well, especially China, deflation to combat the inflation of US will be harder and harder going forward as country putting out fences. So probably I think in the near term, maybe inflation is not as bad as people thought when the starting of the Iran war, but over the long term, that's something to concern.
Got it. Let's just throw in an online question. Again, for the folks online, please use the Q&A window to enter a question, and we will answer them in the order. There's already a question about whether you expect any risk of oversupply in the data centers. Oversupply of compute, AI compute, because almost all companies are building, even Korea is building.
Yeah, really good question, right?
Yeah.
Because you need the data. From what I've read, the AI model factoring actually is pretty compute intensive. But once the models are to a level where we just want to run them and use them for queries in companies, if the adoption's not fast enough, the queries are actually pretty easy to do. Like the tokens are kind of ready to go and answer questions. So it's the model factoring that's taking a lot of compute now. There is another economist on the street that works for Apollo who talks about Jevons paradox. And Jevons paradox basically is AI will make things cheaper, and because it's cheaper, we'll use more of it. Right, and so I think that's the offset to this. Like if all we have is relatively weak uptake of AI, the amount of compute that it needs will be lower than what is needed for the model factoring. But if suddenly the models make things way cheaper for us, we might start using it so much more that it will catch back.
Elasticity, basically.
Yeah, again, Jevons paradox is the like things get so much cheaper, we actually have a huge increase in demand. And that could come.
So you don't see much of risk of oversupply.
I mean, I think it's one of those like 3 years from now, 4 years from now data points.
So how about 3 years from now? Bigger risk?
It's a risk for sure. I'm not an AI enough expert to say whether I think it's going to materialize or not. I just think that the things that are at play that we have to all consider is like how much will we use AI, because there will be extra compute. It's a matter of whether the queries will add up to enough to offset.
Yeah. Wendy, you look like you have something to say?
Yeah, absolutely. I think there are also right now the street are thinking about we're building this mega data center and it's gonna be hit and run and we just calculate the return on investment. Unfortunately, it's not a very easy hit and run because of course you can build a data center within 12 to 18 months, but in order to power those data center and put them onto the grid, you have like 4 to 6 year queuing time in the US in order to get your data center in power. So I would say that the actual landing and actual supply of those data center might take much longer than people expected. And of course, at the same time, you need to make sure you're still competitive, the model is still using, everybody's still influencing drone products or the other. But literally, I don't think the supply buildup, even though it looks crazy now, it probably wouldn't be as fast as people expected.
Yeah, there's a long runway. Okay, there's a question in this room. Any question? Go ahead, please.
Hi. So essentially, Michael Burry recently has announced his short positions against some of the biggest AI stocks, which he has quoted as being as overvalued. Do you have any views on his statements about the current valuation of AI?
Well, I have to say something. Michael Burry hasn't done any good idea in the last 10 years. Always calls it wrong. I love to be Michael Burry, you know. You make one good call and then like you can monetize it for the next 20 years.
Yeah, he's like Nassim Taleb, right?
Yeah, he
100%
opened a
full hedge
subscription
fund
service and charged what, like $200, and so like 10,000 people signed up. Anyway,
It's hard to be a bear when the market
But-
mostly goes up.
good question. Good question.
It is a good question.
Good question. Yes.
Yeah, I mean, what's been interesting is people would say that about Mag 7 stocks a year ago, even though their value, I mean, they had earnings, like they are real companies with real earnings, and so their PEs weren't like the dot-com bubble at all. But those companies have been growing earnings so fast, their PEs have come back down basically to kind of normal enough levels. There was a chart I saw the other day which showed US healthcare stocks have the same PEs as the Mag 7. So earnings are catching up, and that's the whole point of stock markets, right? If your company is growing, then you will have a higher price because the growth earnings will catch up. So that's actually materializing for a lot of the Mag 7 stocks. I guess the semiconductors, you could say, when they got to their tops, had got ahead of themselves, and the earnings were going up much slower than the stock prices were, but they've now retraced down to where earnings are at, which makes the compute question more relevant, because if we don't need as much compute 3 years from now, then maybe they won't have 10 years worth of future earnings at that rate. But for now, the revenues are coming through and keeping up with the prices generally.
Yeah. So let me ask you that question a different way. The investors you talk to globally, are they having the same concerns on those big tech companies?
I feel like the questions you guys
not
are
the first
asking,
time you heard about the question. Right?
Yeah, everyone is asking these questions.
Yeah.
I wish I had a crystal ball.
Yeah.
I probably wouldn't be doing, I mean, I know I'm doing a job in the industry, but I probably have a different job if I actually knew the answer to the crystal ball.
Yeah.
Or maybe I'd just be driving around
Difficult
in a Ferrari.
question to
I don't know.
answer. Yeah. Wendy, any thoughts?
Yeah, I think that's probably actually I see this question from online is probably a good combination of what is just asked. That we're seeing that whether just earning growth itself, it could allow equity market to go uptrend if we're seeing inflation holding up more stubbornly. So actually, as Phil already showing the charts, that the earning growth in Nasdaq and in S&P has been spectacular this year. I think more than 30% growth for S&P, probably higher for Nasdaq. Well, if you look at the stock performance, it's only up, I think, 12% year to date to 30% year to date for those two indexes. So obviously, the multiple is contracted, not only for those stock Michael Burry shorted, like the AI, but kind of for the overall index as well. So at least for this year, on the tailwind of the strong result, we're still kind of like sitting relaxed on the fundamental strength of the US equity market so far from fundamental perspective.
Yeah. So you're not too worried. Okay. Any other questions? Yeah, please go ahead. Yeah.
Thanks, Phil. I found very interesting your point of view on AI capex. Extend to data center. Where do you think the strongest area in value chain of capex in terms of risk adjusted return? Do you think in the capex value chain?
So I think that question is why I end on the chart that I end on. I don't think we really know what customers are going to be willing to pay for. It might not be what we already see. But it's interesting how different companies are dealing with what's going on, right? So NVIDIA really just makes GPUs, although now it's starting to invest in other parts of the supply chain, maybe to diversify itself away from the risk that we're not using GPUs forever. You've got Apple, which hasn't really done anything in AI, but it's got maybe the best tool for us to all interface with AI. So it might still be a winner out of AI. You've got Amazon and Microsoft who have cloud compute. Microsoft has models. You got Anthropic, which is models. Like, there is so many different pieces of this AI puzzle already, and no one really knows who's going to be able to charge the best rent. I thought it was interesting to look at Anthropic's data, even though it's not public yet. It said that it had pretty good growth of actual sales of basically models to retail customers already. So really different to what we saw in the tech bubble, right, where you had Hotmail, right, which was free. You had Gmail, which was free. You had Facebook, which was free. Like, the customer was us, but it was the ads from the eyeballs in the app. Whereas AI is already charging customers for the queries. So if you want a higher end model or you want to do more queries, you actually subscribe to their model. So maybe having a model is going to be the power. We will find out, but it's such a long runway to actually work out what the consumer is willing to pay for, who's going to have the model that we all want to use, whether companies start to deploy them into what we all see and use, like chatbots in service centers or doing coding. Like, these are the use cases, so value is going to come from.
Yeah. Okay, take one more question and we move online.
All right. I myself are quite skeptical of this AI company can really make money. Okay? The reason why I say that is we always have this problem that Chinamen spoil the market, right?
Yeah.
Whenever the Chinese involved in certain thing in a big way, it's always undercutting, and at the end nobody make money. So the Chinese actually very strong in AI. They are very good engineers. They are very good scientists. What is holding back them now is because of those constrained hardware. They couldn't, because all this ban, right? They couldn't buy a lot of hardware, so they were forced to develop like a small size large language model, and then they're trying to use this.
Not small anymore.
Not small,
Yeah,
but small compared to the Americans, and then they have to use distillation method to improve it, right? But sooner or later, one day, they are able to make their own hardware, and then they can improve their AI software, and I believe eventually the AI software will be even better than the Americans one, because whatever the Americans do, the Chinese have many more headcounts doing it, right?
Yeah.
So when they are so good that one day they are better than Americans, and they always offer a very, very low price and things like that, then in that case nobody make money. Right.
Well,
that day will happen. I don't think we'll be very far. Maybe 10 years down the road.
Well, I'll let Phil and Wendy share their thinking, but let me give you one example.
Yes.
Alibaba.
Yeah.
Pinduoduo.
Yes.
JD.com.
Yeah.
How come Amazon still makes the most money? Amazon did not die. Okay. Chinese did not kill Amazon's business. Okay, go ahead.
None of those companies are in America either, which is kind of my answer.
That is thinking that maybe the Chinese will overcome all the
and it's
AI
tech, so theoretically, like, you just create a VPN and you can use a Chinese model. And I disagree that they're worse models. I think the data right now shows the models are pretty close to parity. I think the thing that's holding it back is concerns about control of data. All right, and so Europe's had GDPR forever. I think America is starting to realize that its national security requires it to be able to run its own queries and have its own industry. And so I think very different to the 90s when China was led into the World Trade Organization and it undercut a lot of manufacturers. The world's thinking is different on things like that right now. So I think that could not stop China from advancing, but make its market more constrained than a global market would be.
Yeah. Wendy, you also invest heavily in China before. Anything on the US versus China AI and whether
Yeah.
China will ruin the party? Kind of like, actually, you have a good point. That's a good question because in the EV space, certainly China is taking over. Right?
Exactly.
In Europe,
And
but not in America.
Not in
Well,
America.
that's a
but-
very good parallel because I was just thinking that, and I completely agree with Phil said that right now, actually, in this AI era, we got a lot of repeat building. Why do I say that? So, for example, if historically you got a BYD at your house, you probably don't bother having another Tesla or two other Tesla because you only need one. However, because of the security sensitive or security nature of AI, all the country, even though you have DeepSeek, you have OpenAI, you have cloud, you're still building your own because you don't want one day either China or US cut you from their chain. So literally that's probably this round of AI innovation is less commercial than what we see back in the EV era because before it's a pure consumer decision. Whoever's cheapest, I use who. But now with AI, it's not only consumer are using that because I assume consumer-related revenue is still relatively small. But since enterprise and the state, nation, security related are using those, they are, I would say, much less price sensitive in a sense compared to consumer product. And also because of the fact they need to preserve data at their own ground, as we see before. So this round of this whole Chinese price kill everybody else's price will be much slower than the previous history.
Voice. Okay. Yes. But that's a really good question. I think. But regardless, I think whoever wins, the Chinese are likely to make this more profitable. I think there was a question earlier about business model or the feasibility or sustainability of the AI business. Look at, again, Amazon's case. Amazon started business earlier. They were only profitable in 2003. Alibaba was able to learn from Amazon, but they make it profitable in 2000. So AI is the same thing. I think the Chinese will figure it out really quickly how to make money from it. Okay, let's switch online. I think there's a question again on the U.S. midterm. Wow, that's a very sensitive topic. Do you cover politics?
Not very much.
Impact on the stock market, and that's coming up, by the way, November 6th. And which sectors to benefit or be a victim, that kind of things. No?
Yeah,
Nothing special?
I can speak at a really basic level to the election. I mean, I think the consensus is so we have two houses. We have the representatives and the Senate in Congress, and you also have the president. Obviously, the president's not up for election, but people in both houses are. The Republicans are in all three right now with control. The consensus is the House will go Democrat, and maybe the Senate will go 50-50 or very slight Democrat. But even if just the House goes Democrat, it's going to be really hard for Trump to get as much of what he wants and has been able to get done. So I think the last 2 years we'll see, I guess, less things happening, maybe less volatility. And typically the year after midterms is a pretty decent year for equities. And the year into elections not bad either. So it might not be bad for stocks if we have like a split house, so they speak, after the election.
Yeah. Wendy, do you follow the midterm?
Oh yeah, we had actually quite extensive discussion last time in Singapore with the midterm. I think surprisingly, after a couple of months, the odds is still the same. That Democrat is taking over the House, while the Senate is like half and half, maybe 55-45 or something. So general rule of thumb, when people think that if you have Democrat in power, they likely push more, like say education, accessibility of education, accessibility of healthcare, and probably curb more on those what we call big capitalists, such as Wall Street broker, maybe the AI company, as well as the oil traditional energy company. So that's kind of like general rule of thumb for Republican versus Democrat. But I think this year something is very relatively more interesting is that we probably eventually, if Democrats win over the entire Senate, entire Senate plus the House, there are some concerns that whether they will curb some of the crazy deed that Trump had been doing when he have pretty much the entire Parliament as well as the White House in his control. So when you have a split government, that means that you're going to have a lot of query, probably headline news from Trump office on daily basis, but nothing get done. So potentially we will see a lot of discussion, but no longer kind of like either Iran war or the tariff impact we see Trump can easily push through during his first 2 years. So potentially that's something going to be stabilizing. And as Phil correctly said, that if we look at midterm election history over the past few decades, that's after midterm election, you always see the U.S. equity, either it's Nasdaq or S&P, trending up. While before the midterm election, especially the 2 to 3 months before, there will be most of the volatility happen because both parties are trying to make a show to win over the voter, and their policy announcement can be very extravagant.
Yeah. Okay. There's another question on inflation. I think we answered that already about whether inflation acting as a overhang on the stock price and the earnings growth. I think earning growth remains strong. That has been supporting the stock market performance. Will probably continue to support the market.
Yeah, I mean, I think it's the inflation is more a risk that rates increase rather than inflation being the reason that things are up.
Sure. Question on U.S. national debt. Very timely question. Really good questions online about the bond yield. We all saw the bond yields record high, 10-year, 30-year, market nervous, Treasury intervention, and what's a view on the long-term yields and also de-dollarization, and recently the dollar also devalued as people worry about the U.S. debt burden.
Yeah, I mean, the US debt is definitely a hot topic when I'm talking to corporates because they're used to managing their balance sheet and making sure that they aren't levered too much. They often ask about the federal government. So we're running about $1 trillion deficit or more every year, and we have a pretty good economy, right? We have decent tax receipts. And so what happens if we have a shock? And what happens if interest rates keep going up? Like already in America, we have $40 trillion of deficit. We have interest rates at sort of 4.5%. The cost of interest alone is 1 in 5 of my tax dollars. Right? So it's kind of becoming a fiscal constraint. When it breaks is kind of an interesting question though, right? So Japan is one example where it has 250% debt to equity, debt to GDP ratio, and it's been fine for 30 plus years because it's also had interest rates are basically zero, right? So when it can afford to borrow because it really doesn't have to pay interest. The flip side is what the UK saw a couple of years ago when Liz Truss became Prime Minister for a hot minute, because she came in and she announced some kind of irresponsible fiscal programs like when you just mentioned, and the bond market is like, I'm not financing that. And so when the bond market doesn't want to finance it, there's no buyers for the bond. If there's no buyers, the price of the bond goes down, which means the interest rates go up to borrow. And so they went up so quickly, they had a little financial crisis of their own, and they had to unwind her policies and get a little bit more responsible. In the US, I know the Fed governors have had conversations in public that they're concerned about the level of debt, but they realize there's no political will yet to get really.
There's never political will. I mean, both.
Well, I think a Liz Truss would create it, right? A Liz Truss moment in America, and that's why this week's kind of interesting to watch what's going on. Because if the rates keep drifting up, even though inflation's coming down and maybe the next rate change is a cut, like if the short end's going down, how come the long end's going up? Yeah. Is it credit risk? Is it American exceptionalism?
Yeah.
Is it inflation, or is it a combination of all three?
I think all three. Yeah.
Yeah, and so there are concerns, and eventually it will create political will.
Yeah.
But probably not until it gets
I
too
doubt
expensive.
it. But you said earlier the Fed rate hike could be a moment of correction for the global market, equity market. What about the bond yield? If the bond yield continue to go higher, will that also become a risk to equity markets?
I mean,
Theoretically, should. right?
theoretically, yes. I mean, in theory, a stock is like a perpetuity, so the longer term rate should be your discount rate. So long-term rates going up should make the value of stocks go down, because the profits 30 years from now aren't going to be worth a dollar for dollar, because we're going to have inflation, we're going to have costs of interest. So theoretically, you're right.
Yeah.
I think the bigger risk right now with what's happening at the long end of the curve is it's those three factors we talked about, and it's going to be a more structural problem for America to borrow longer term, and it's going to have to really refactor its economy. But it's not like it's just the US that's seeing the long-term rates go up. All of the developed markets are seeing this happen at the moment.
Yeah.
So maybe it's actually the market saying we're going to have structurally higher inflation, and I'm wrong, and the demographics don't matter, and we'll actually just have higher rates in the future because we have stronger inflation, and AI is going to make productivity go up so much that the debt will still be affordable.
Yeah.
Which is possible, right? Possible.
Yeah, possible. Let's remain hopeful. One more question on the. It's a very long-winded question, but I think what he's asking is about when, first of all, the AI fundamentals will peak out. That will probably related to capex, because we did have a prediction about AI capex will probably slow down this year, but did not. It turned out to be the wrong prediction. But what about 2027? Will we see a slowdown? Absolute number could still be 30-40%, but versus 80% this year, there's a slowdown. So that's the peak. And what AI, when AI fundamentals will peak, and then I think it relates to also the stock price. Stock price is hard to say because long-term stock price always go up. U.S. stock, the beauty of U.S. stock market, that it may go through correction, but if you look at longer term, they all go up, right? So it's hard to call the top. But let's just focus on, let's say, the AI capex peak and AI fundamental peak. Will we see that in the next 2 to 3 years?
I mean, stocks are a good inflation hedge. So,
Yeah.
like, if costs are going up, then sales prices go up, and
Yeah.
prices go up because revenues go up. It's a really interesting question, because I think there's so many unknowns.
True.
One of the things I think of as an economist is when you look at the internet build, it took 10 years to build the internet. The actual productivity came through 10 years after that, right? So the 90s was the internet build, the noughties was internet productivity gains. And in America alone, our productivity over 10 years increased 1.5% per year, so 15% in total, right? We have a $30 trillion economy. So you do the math, so it's like 4.5 trillion more production a year in the GDP because of all that productivity gain. So from an economic perspective, I can see all the trillions of dollars of expense making sense to us as a global economy. I mean, if what I just mentioned, if it makes us so much more productive that we can all afford to retire and not worry about debt to GDP, it's a total home run.
Yeah.
But we have to see the productivity come through. Right now, there is no evidence that AI is causing productivity gains. I think it's way too early.
Wait, it's too early?
For productivity gains?
Last year, we really saw some productivity gains. It's not related to AI?
I don't know if Wendy was sitting here. She might argue with me about productivity gains. It's one of those topics where two economists will not agree.
Wendy, any thoughts on the last question? The peak.
Yeah, probably
Inevitable peak.
On the AI, I think that's it's a very good point, is that people are not really looking at the absolute growth. They're looking at the velocity of growth. Like if you're already seeing 80% growth, 70% growth this year, next year, even if you have 40 or 50, I still consider that a deceleration, and I still want to go ahead. Fair. That's what happened if in a highly growth industry, that everybody is betting on on high leverage. That's what happened. However, when we're looking at those beneficiary of those capex, Magnificent Seven per se this year, they are not the one that's growing the fastest. As Phil showing in the chart, that most of the beneficiary we're seeing this year, memory, opticals, semi, etc. However, those companies spending on those capex, they are not really benefiting as much stock-wise price perspective. So you can almost say that this discount on their growth, because if we only look at the fundamental EPS growth, they are like definitely justified for more than 10% this 10% the S&P and Nasdaq growth. So you can almost say that this discount on their multiple is already priced in, especially for those hyperscaler that's mentioned here. So whether we will gonna see that's gonna to impact some of the hardware supply chain or memory or those beneficiaries this year is up to, of course, that's will depend on how much more they can keep on delivering on pricing, they can keep on growing at an accelerating rate. But at least I think from hyperscaler perspective, they're almost like already been punished because of that.
Got it. Any last questions from this room? Anyone? Okay, if not, it will conclude today's session. I want to thank everyone for taking your valuable time to join us. You've been a great audience, great questions. And if anyone required today's presentation, I see you guys taking photos, we will send it to you by request. Please talk to your UOB Hian representative. Thanks, Nasdaq. Thank you, Phil.
Thank you very much for having me.
For a great session.
Fantastic.
We will still
Thanks
stick
a
around
lot.
here if anyone want to have some chat. Yes.
Thank you once again, Chi, Phil, and Wendy for this insightful discussion. And thank you everyone for attending our CIO series exclusive session with Nasdaq. To find out more of our information and offerings, you can go to our website, uobkh.com.sg, or scanning the QR code. And you can find out more similar seminars by scanning the QR code or go to our seminar page. Or you can stay on top of the market trends by subscribe to our research reports. Thank you, everyone, and see you guys again. Thank you.